The old saying goes, only two things in life are certain, death and taxes. Well, the 5 things you can do now that could save you a load of dough come April 15th.
Well, with the hustle and bustle of the holiday season, we've got a lot going on, don't we? The last thing, though, that most of us are thinking about are income taxes. Well, according to our next guest, that is a big mistake. He says there are 5 things we can do right now to save money on April 15th. Gene Marks is a New York Times columnist and small business owner of marksgroup.net. All right, everybody listen up. I know we're not thinking tax time, we're thinking Christmas time. We got 2 weeks to spend all this money before Christmas comes, but we really do need to follow our taxes, and more specifically, number 1, you say follow the Bush tax cuts debate closely to determine your income shifting. What does that mean?
Yeah, that's right. And Julie, I feel like such a Scrooge bringing up taxes here in the Christmas season.
Sure, but you know what? Somebody's got to do it, so we'll let you.
Somebody's got to do it. So yeah, so we're talking about shifting your income. So as we all know in the news, the Bush tax cuts are coming up probably for a vote next week. So if you're running a small business or you're a proprietor, you want to keep a very, very close eye on those Bush tax cuts. They really should be continuing on. I don't think they're going to expire, so the rate should stay the same. But God forbid if it does get overturned and rates are going to be going up next year, you're going to need to do some income shifting, meaning you want to bring some income into this year while your tax rates are still lower before they go up to next year. Hopefully that won't happen, but if you're running a business, keep a close eye on it.
Okay, there are measures you can take advantage of by writing off capital purchases, and I guess this is something that a lot of business owners need to hear, so tell us.
Yeah, it's a pretty big thing. It was actually, this law has been around for a while. It gets renewed every year. It's the Section 179 rule. Make sure to ask your accountant about it. If you're running a small business and you're looking to get more depreciation or deductions on your taxes this year, write off assets. You can actually write off up to $500,000 in capital equipment that you buy. So for example, if you buy software or furniture or hardware, that kind of stuff, you can have a big tax advantage by doing that. And one other thing about that, if you're selling capital equipment, if you're in that business, go to your customers and say, hey guys, you can get a tax advantage by buying some of my products this year. Maybe you can get a couple deals done before the end of the year.
Oh, it's a good way to get some new business if they think that you're looking out for them. All right, number 3, write off unnecessary inventory and accounts receivable. And I guess this is something many business owners forget to do.
Too many of us are just too optimistic. We're just too happy and looking forward to the future. So, if you're running your own business, Julie, look at your receivables, look at your customers. That guy who's been owing you money since 2005, he's not going to pay it. Just admit it. So, write it off. If you have inventory that's been sitting around since you moved into your place and you're positive you're going to sell it, write that off as well if it's not sold by now. If you take the write-off, you can take a big deduction for it right now.
That is a great idea.
Business owners just they don't take advantage of that.
Okay, and also take advantage of the startup expense deduction or new business investment. How does the jobs bill passed by Congress this fall give an increase in the deduction for entrepreneurs' startup expenses?
Well, what it's doing is it's increased the deduction to $10,000. So if you've started up a business this year, or if you're kind of in the process of doing it, before the end of the year, get it incorporated, get the paperwork filed. You can take a $10,000 deduction for any of your startup expenses. So if you started up a new website, or you moved into a new office, or if you're paying an attorney or an accountant, the old tax rules kind of let you, they told you that you had to capitalize that and take a deduction over the next few years. Okay. This year, you can take up to $10,000 as a deduction for a startup. It's pretty good stuff.
Okay, number 5, finally, set up an SEP. That's a simplified employee pension plan. I had no idea what the heck this is, but how can this provide a significant source of income at retirement?
Well, I'm going to teach you. I'm going to teach you right now, Julie. An SEP plan, it's a simplified employer pension plan. Very, very simple to set up. All it is an IRA. It's a tax-deferred plan for you and your employees. Your accountant can do it. Your banker can do it. Really super simple. Basically, what it means is that you can contribute money for your employees' retirement and your retirement too, and you can take a big tax deduction for doing that. Plus, you're helping your employees kind of set aside money for their retirement in the future. So if you have no retirement plan in place, an SEP plan is really, really super simple to do. You can get a deduction for putting money away.
Very cool. All right, Gene Marks, thank you very, very much for reminding us tax time's around the corner.
Thanks, Julie. Have a good holiday.
All right, you too. Greg.